Hello, everybody, and welcome to the March edition of the Monthly Market Monitor. My name is Wade Cooper. I'm a financial strategist for Corporate Central. You can see my contact information there. I'll put that up at the end as well. So please let me know if there's any information you need after this. Let's just jump into this. We got a lot of things happening right now. You may have heard about Chairman Powell and the hearings going on yesterday and today. And the next Fed meeting's March 22nd. So with all that in mind, I just wanted to take a look at the Fed meetings of 2022. I'm sure most folks are familiar with this, but I'd like to wanted to remind everybody of where we were at a little over a year ago, and about a year ago we were sitting at this level for you can see the March 16th meeting. We went up 25 basis points, and then from there went up 50, 75, 75, 75. So where we're sitting, actually went up again. So I wanted to keep this in mind as we're listening to a lot of the things happening in these meetings, in these hearings. You're going to see a lot of press on that in the next couple of days. There was some already from yesterday. Senator Warren grilled the chairman a little bit, so I'm sure there's going to be some more of that today. But the reason I bring all this up is because this is what happened last year, and we look at the Fed dot plot from a little over a year ago. This is 12/15 of 21. So the Fed dot plot, you can see the yellow dots are where each of the voting members think the Fed funds rate will be. The projection for the end of the year. So of course, this is 12/15/21. The end of 21, you can see everybody's in agreement and just above zero. And then you can see the further you go out there, there's a little bit more disagreement, which makes sense. But the median is where that green line is. So at the end of 21, the projection was just under 1% at the end of 22. And then looking out to 23, we were going to be somewhere between 1.5% and 2%. And then in 24, slightly above 2%, stated goal. Nice clean line. So 3 months later, keep in mind, we were at they were projecting just under 1% for 2022. 3 months later, at the 3/16 of 22 meeting, Fed dot plot, the end of 22 had them at just under 2%. And in 23, going up to about 275, and then we're going to level off by 24, stay at about the same rate, and then start coming down. And that was a pretty big change in 3 months. And when we look at 1 year later, we can see where we're at the end of the year of 22. We were just under 450, and by the end of 23, they're projecting that will be just above 5%. And then they're going to drastically start cutting, as you can see on this graph. So what a difference a year makes. Again, you can see the end of 22, just under 1%, and where it ended up was just under 450. The end of 23, a year ago, a little over a year ago, the projection was about 175, and now we're looking at north of 5%. Now this comes out quarterly, so we'll see another one of these soon. But so this one, just for example, the 12-14 one in 3 months, I'm going to be very interested to see what the next dot plot says, because there are people thinking that we're going to hit 6%. And so in just 3 months, we're going to go, if that's what people, if that's what they really think, we're going to see that line move up again, or the median move up again for the end of 23. And you can see that, on the right hand side, that graph, there are a couple voting members who think it's going to be north of 550 from in 23 and 24. So then there's some folks who really think it's going to go down too. I'm not here to say whether or not they're right or wrong. It just kind of illustrates the point that there's so much information coming all the time that just within 3 months, you see a huge difference, or one year is a gigantic difference. 3 months was still pretty big. It was still pretty significant. And even to dig on this point a little further, the weighted average Fed interest rate projection, you can see the bar on the left, in the red or burnt orange or whatever that is. That was from January 11th. 1 month later, they were projecting in blue, that's February 11th. 5 days later, the green bar, and then the gold bar is 11 days after that, February 27th. So in the matter of 6 weeks, from January 11th to February 27th, you can see the differences in, let's just take a look at March. January 11th, they were thinking we were going to be at 473, and 6 weeks later, that jumped 21 basis points. And the further you go out, the larger the jump gets. So in May, they're thinking they were in January, on January 11th, 497, and then that jumped to 520, so 23 basis points. 499 to 531. And this is what's interesting. So in a matter of 6 weeks, if you look at from June to July, they were thinking the rates were going to start sliding at that point. And then 6 weeks later, we're still on the rise, 531 to 546. My guess is if they did that right now, it would be even higher, because there are some people calling for 6% by the end of the year. But 6 weeks ago, they thought that was going to start cutting, and by December, get down to 432. And even on February 27th, they thought there was going to be some, that it was going to gradually start coming down a little bit at 531. So this is, again, and this was a matter of weeks. So I just like to, there's a lot of information coming at us. There's a lot of noise. It's good to pay attention to the rates, the projection of the rates. I think it's more important to be able to react to the rates, and be prepared either either or, whichever way they go. And I also like to tie these things back to credit unions. So there's the big overall picture of what's happening at the Fed and in the marketplace, and then how does it look or how does it affect or look towards credit unions. So let's just take a look at yields. Now this is yield on loans. This is a Callahan chart. This is all credit unions in the US. And in what typically happens on these, the yields, the blue line, if I do all the peer groups, the larger ones will, for yields anyway, will be above that blue line, and the smaller, the peer groups smaller than would typically be under the blue line. But the billion plus credit unions would have two lines, actually, billion to 10 billion and 10 billion and above would be above the blue line, and then all the other peer groups would be under it. But they all generally move in the same way. But this is all credit unions, and we could see fourth quarter of 17 where we were at, and moved up, and first quarter of 20. Keep an eye on that, because I'll be going back to that quite a bit. Was the start of the pandemic and shutdowns and everything else. So you have your yields kind of topping out right at that point, and then we start moving down. First quarter of 22 is when we started seeing all those rate hikes. So we were still going down, and this makes sense because you still have all the lower yielding loans on your books from here. Even if you raise your rates immediately or in tandem with the Fed, which most folks didn't, but even if you did that, they're still going to be lower because you have all these that you put on the books back here. So anyway, we are raising, the yields are going back up. That's a good sign. It'll be interesting to see if they keep climbing at a higher rate as rates keep going up. So again, pay attention to what's happening at the Fed. The other thing to think about is cost of funds. That part makes me a little nervous with credit. There's a lot of credit unions I talk to think their members will never leave them, and the money's going to stay, and then boom, they find a 4% CD somewhere and they start pulling out the big money. So just something to keep an eye on. Upcoming economic data. So the unemployment report's going to be this Friday. It's usually the first Friday of the month, but that would have been on the 3rd, and maybe they didn't have enough time to put it together, so got postponed to the 10th. So we have a lot of things happening in a short amount of time, from the 10th to the 16th. Unemployment, CPI is coming out, and PPI. Of course, those are inflationary. That's inflationary data. The home builder survey will have initial jobless claims, building permits, and housing starts. And I'm tying that into, we'll start with the housing first. Housing versus rental affordability indices. Now, this is essentially rent income, and which has stayed fairly flat over all this time. That was very surprising. I hear a lot about, anecdotally, about rent being very high, and then when you look at the rent to income ratio, it's actually stayed pretty pretty flat. Now I know different markets are different, so anyway, it's interesting. But then you look at the mortgage payment versus income ratio. Well, that hasn't. I mean, that moves up and down. There's some volatility in that, and right now it's less affordable than it has been for a while, and you wonder, is that which side is it, supply or demand? Is it, are there not enough housing units on the market, which drives the price up for the demand? So I would probably argue that's the case. And we have some more slides coming up that might bring that out a little bit more. This is the month over month change in national rent, and I'm going back to rent just because I thought pre-pandemic, you see these 2 years were almost identical. You have a negative number here, it's positive for 7 months, goes negative for 5 months into the first part of 19, then it goes positive again. So there's a pattern there, and then we started the pattern again, and then bam, COVID hit, and rents went down, and it really these 5 months kind of are different from the last 2. Then you see the rents go down again, and then shoot up, come back down. Now they shot up again, but not as much, but they've gone down quite a bit since then. So hopefully we get back on to a regular cycle, and things are starting to hopefully normalize. All that being said about the rent, you can see again the last 20 years or so how much it's gone up, and it's gone. Looks like we have a spike here, and then it might start coming down. So be interesting to see in the next couple of years if that starts moving down more, which again, I'm no housing expert, but it's the thought of, if there's not enough housing, if there's not enough units being built, then you would think that would drive rent up as well, because of the rental units would be in demand too, but doesn't seem to be the case. Existing home sales, this was the 12th straight decline. So this kind of shows what we were saying a couple slides ago about the affordability. So if there's less on the market, then that would raise the price. So the lower supply, higher demand is going to raise the price. Bringing it back to credit unions, real estate origination. Again, this is all credit unions. Going from 17, fourth quarter of 17, and see there's the downward slope. If we look at the last year, the last 12 months, just like the last slide showed, the decline in sales. This was the decline in originations. So that adds up. The next slide is the one that doesn't add up. I read an article, and it was this slide puzzled Paul Krugman. Now, if you can say what you like, you may like Paul Krugman, an economist, or you may not like him. But it piqued my interest that this chart puzzled him, and for good reason. The blue line is all employees for residential building construction, and that's been on the rise. And then you see the red line is new privately owned housing units started, total units, and that has gone down quite a bit. So how do you have more people working with less housing starts? The very it really doesn't make sense. It seems like one of these would either the red line would have to start going up, or the blue line's going to have to crash down. I'm hoping it's not the blue line crashing down, but I mean that would make sense that that's where we're headed. And we're going to be seeing more about unemployment. This is where I'm tying housing into unemployment, because now there's been you may have seen all the tech layoffs happening, and in the last year, you can see where the red bar is the employees laid off, and the blue bar is the companies with layoffs, and and this is all tech. You can see all, or the red is the tech employees. So it's just, to see all the tech employees, and you may have heard, it's the big guys too. It's Microsoft and Amazon. We've heard the saga of Twitter, but Facebook, Meta, that was just in the news again yesterday. They've laid off some already, and now they're talking about another round of layoffs. And we start thinking about these things because that's one of the things that the Federal Reserve is looking at, and Chairman Powell's looking at, are layoffs, or not layoffs, but unemployment, or the strength of employment, the labor market, if it's a softer labor conditions, which means layoffs, right? That may lead to slowing down of the interest rate hikes, the more layoffs there are. But again, that's just one component of it, and I'm it's worth keeping an eye on. The other thing, this is large bankruptcies. These are companies with large bankruptcies in January. Haven't seen this level since 2010, which again is when I think bankruptcies, I think layoffs and unemployment. And tying all this back to credit unions, more importantly, I think delinquency. So this chart, as you can see the spikes. It always spikes in the fourth quarter. And so we got the fourth quarter 17 coming out of a spike into 18, fourth quarter 18 spike, 19 spike, even with, so this is where COVID hit, was first quarter 20, fourth quarter spike. We're in COVID during this whole time. We still get a spike in 21, and now fourth quarter 22. I'm really hoping the first quarter of 23, this line will start going down again, and instead of keep rising. But that's quite a slope that we have there from first quarter of 22 to the fourth quarter. So that jumped quite a bit. So I'm really hoping that we see that come down the first quarter. That's how I think of delinquency. Obviously, delinquency looks cyclical, but layoffs aren't going to help anything out, right? let's look at, let's just touch on price changes. So, I mean, you can tie this into the CPI a little bit, but the and this is over the last 20 years, so that's not exactly a fair comparison, but it's really interesting to see what has risen. Hospital services, college tuition, no surprise there. College textbooks has its own category. Medical care, child care, um, food, housing. Um, and again, this slide might be a little stale because that might be up a few ticks here. Same with new cars. If you've gone car shopping lately, there are a lot of new cars that are pretty expensive. So um, what's not a huge surprise is the technology. As technology gets more, just technology moves forward, it gets cheaper. So you have TV, software, cell phone services, all um, cheaper, less expensive, shall we say? Um, and so, we were talking about delinquency before. This could be related to um, credit card loan delinquency, as well as now this is always higher than your typical delinquency, but we get the same spikes. It's 17, again, higher percentage, but about the same spikes. But again, this is really kind of driving up here in 2022. So hopefully we see it come down. Um, I'm running out of, I'm getting close to my time here, so I apologize. I'm going to start moving a little. So again, tying everything back to credit unions, net worth to assets. So again, first quarter of 20 is when this is the start of COVID. So we were staying between 11 and 1150 for a couple of years. Then we dropped significantly, leveled out. We had some government money hitting our balance sheets quite a bit into share accounts in all of 21. And now we're seeing this is coming back up. So we're between 1050 and 11. Hopefully soon we'll normalize and get back up into this area, but we're heading in that direction. And then this is probably this is going to be the last slide, and I picked it for a reason because I like the normalization of things here. So we have our ROA. This is all credit unions. We're at 80. We were in fourth quarter of 17, between 80 and 1%. We were sitting there. Of course, COVID hits. All right, boom, really drops our ROA. Helicopter, the government money starts coming in, and it pops us up between 1 and 120, and now we're back a little bit lower than this line, but we're still in between. We're in that range. So hopefully, again, normalizing. Rates are going up. How that's going to have an effect on all of this is anybody's guess. Again, not a great track record on making predictions, the Fed, or anybody else for that matter. So, keep all of that in mind when running your credit union. It's going to be a lot of noise out there, but just be prepared to react. If you have any questions or any thoughts on maybe what I got wrong, let me know. But I appreciate the time, and thank you very much for listening. Have a good day.